In this video, we're going to talk about the recent massive China stimulus that has the potential to revive China's economy and both its stock and housing markets along the way. Their stimulus announcement has driven Hong Kong's Hang Seng Index to produce a historical power rally that is viewed as being one of the best in many decades. Shout out to Zen Business for sponsoring my research today. More on them later. Now, the new stimulus news from China is very good news for all of us because China is responsible for about 20% of global GDP. So economic strength there bodes well for our economy as well. Now, the policies that China are implementing do need some explaining in simple terms, and that is my goal in today's video to get everyone up to date on the recent developments. Before I go through all the policies that China is putting forth, I want to talk about the economic backdrop leading up to this point. So we all know that China's economy has been in a tougher landscape for the better part of the last 3 years. The property market is a substantial portion of household wealth in China, and the downturn in housing has made consumer confidence fall to a multi-decade low. China's cities are separated into 3 categories: Tier 1, Tier 2, and Tier 3. Although the big cities such as Beijing and Shanghai are what we are most familiar with, it is the Tier 3 cities that drive the lion's share of GDP in China. They contribute about 60% of the country's GDP. We can see from this chart that it is the Tier 3 cities that have felt the brunt of the property downturn, and that is the reason consumer confidence from a national level has been so weak in the past few years. Now, with the rising pressure that China is encountering, such as youth unemployment and the desire to meet the GDP target of 5%, last week China announced a bazooka stimulus effort that is comprehensive enough to change the economic outlook. Let's take a look at the stimulus plans that have been released so far. There potentially may be more coming, and I will cover that in my Substack below, so make sure to subscribe. Now, it all started on September 15th, where China's Central Committee and State Council issued public guidelines to promote employment, because we know that's a big problem. There were a total of 24 points on specific measures that aren't fully publicly disclosed. Generally speaking, though, the priority is for there to be sufficient employment opportunities to promote economic and social development. To do so, the 24 points included fiscal, taxation, financial, social security, and other policies that will be deployed to guide various types of entities to expand employment. Now, that following week, on September 17th, People's Bank of China Governor Pan Gong-Seng had a special news conference to begin reviving consumer and investor confidence by kickstarting monetary easing. What he essentially did was create 2 structural monetary tools. One was to create a swap facility for financial companies and allow them to directly obtain liquidity from the central bank through asset pledges. This is huge because it allows these institutions to increase stock holdings and acquire more funds. The second initiative was to create special relending for stock buybacks and increased holdings, guiding banks to provide loans to listed companies and major shareholders to support stock buybacks and increased holdings. I know that might sound confusing, so let me break it down for you. What this means in plain English is that there is more liquidity circulating the system and more capital can be tapped by institutions. Think of it as being able to have easier access to credit and larger access to buying power in your portfolio, even though you don't deposit additional funds. Now, it was reported that the initial swap facility would be 500 billion yuan, and the highlight here is that the funds obtained through this channel can only be used for investing in the stock market. Now, this tool is applicable to listed companies of different ownership types, including state-owned enterprises, private enterprises, and mixed ownership enterprises. This literally means that the government is encouraging capital to flow into the stock market because to tap this liquidity, it has to go into the equity markets. During the press conference, PBOC Governor Pan Gong-Seng even stated that they are actively researching the implementation of a stock market stabilization fund. And then as a follow-up, he said that the PBOC would reduce the 7-day reverse repo rate and also cut the reserve requirement ratio by 0.5% and also signal another cut of 0.25 to 0.5% later this year. It's estimated that the RRR cut would add about 142 billion of liquidity into the banking system. The translation here is that there is going to be much more liquidity in the system, and this reduces the chance that a negative credit or liquidity event occurs. Now, there is much more to talk about, and the biggest stimulus update is actually just ahead, and I'll talk about that in a few minutes. But before we do so, I want to thank Zen Business for partnering with our research video today. So as we get into the late cycle of the economy, it is probably one of the best times to get into entrepreneurship and start a small business while the consumer spending environment is still strong. Starting your own business, though, is both exciting and overwhelming at the same time because of all the steps involved. There is a solution for future entrepreneurs who want to make starting a business a more stress-free experience, and that's where Zen Business comes in. Zen Business is a powerful solution to help streamline the entire checklist of starting a business. LLC formations, annual reports, and business bank accounts. The coolest part is that the starter package starts at $0 plus state fees, so Zen Business is accessible at any budget. Zen Business is very helpful because it's fast and it's easy. They guide you through every step of the formation process. You just answer a few questions and Zen Business takes care of the rest. They even help to make sure that their customers stay on top of legal requirements and never miss any legal documents. Their pricing is upfront and you know exactly what you're paying for. No hidden fees or surprises. Now, I think that the best perk at Zen Business that they offer in their solutions is they have customer support 7 days a week by chat and by phone, and this is particularly useful because there will definitely be questions along the way early on in a small business owner's journey, and it's super helpful to have access to support whenever you need. It's also very neat that their starter package, which starts at $0 plus state fees, includes customer support so that anyone starting out gets that support. If you're currently working to start your own business, platforms like Zen Business can help you focus on your top priorities, which is most likely product development and sales. Meanwhile, they take care of the time-consuming aspects like business formation and compliance details. So if you're ready to start your business, head over to zenbusiness.com and click Start an LLC. Now, back to the video. Policymakers weren't just done at the rate cuts, though. Just a few days later, they also released property market stimulus by reducing existing mortgage rates on average by 0.5%. This lets consumers refinance their mortgages with different lenders, so this means an immediate savings per month on their payments. The government is also lowering the down payment for second homes from the current 25% to 15%. Now, one of the popular China news analysts, Sinocism, on Substack did an amazing job at translating recent Politburo meetings of China's top policymakers. I'm absolutely amazed at the pivot that's going on here. Let's take a look. I'm going to read what he wrote out in bold. See here. It is necessary to issue and utilize long-term special government bonds and local government special bonds to better leverage the role of government investment. The reserve requirement ratio should be lowered and substantial interest rate cuts should be implemented. Efforts should be made to stabilize the real estate market. Public concerns should be addressed by adjusting housing purchase restriction policies, lowering interest rates on existing housing loans, and efforts should be made to boost the capital market, vigorously guide medium and long-term funds into the market, and resolve obstacles for financial companies and funds entering the market. Okay, let's take a step back and soak in what we just heard here. The intention here, I believe, is a big positive reversal of all the things where restrictions have taken place since 2021. Language on supporting the stock market was previously not a big priority. Here we're seeing statements that directly support the stock market, the housing market, and we're also seeing encouragement for long-term funds into the market by removing obstacles for companies to enter the market. There's also language to support M&A in China, which has been very slow over the past few years. On top of all the monetary easing and stock market initiatives described above, China is now also engaging in fiscal stimulus by issuing 2 trillion worth of yuan to stimulate consumption. And this is big. Let me explain why. Fiscal stimulus is very important because it has the power to dictate the direction of national inflation from direct government spending. Now, some specific initiatives, and this is big here, that are being discussed are that the government may give 800 renminbi monthly allowance for families with 2 or more children. This could potentially be the beginning of a larger effort to stop the birth rate from declining. This type of stimulus is almost as powerful as when the US gave out checks to households during the COVID era. That's how large this stimulus scale is. Given that the greatest fear around China right now is related to deflation, this large fiscal stimulus news is a very welcome development. Now, in our community on Substack, on the day after the first monetary policy announcement was made, we discussed the opportunity in fundamentally undervalued names like PDD and EDU based on our DCF valuation model. We specifically said that we liked PDD at 115 and EDU at 60. Stocks are moving around all the time. But at one point, PDD got to 155 and EDU got to 90, which is about a 50% rally from that entry that we discussed. To put it in perspective of how big a move that is, these companies went from my DCF bear case, which is the pessimistic valuation scenario, all the way to my DCF bull case, which is the optimistic valuation scenario, and that pivot happened all in a couple weeks. Now, David Tepper recently said on CNBC that he was buying everything in China, and I think that's a powerful strategy in this context because China stocks are so heavily correlated to one another. So the bottom line is this: China's massive stimulus push means that its economy has begun the long journey in recovering, and its stock markets and housing markets are going to officially attract investor capital again. This means I'm going to begin discussing the opportunity sets within China ADRs and Hong Kong H shares within my investment community more frequently on Substack. Now, China's goal to meet their 5% GDP target with their stimulus package will also set the stage for global growth to have a longer runway, which will benefit the US and Europe. This could mean that a global recession has likely been averted and that a multi-year recovery in China in their stock and housing markets has just begun. We'll discuss updates more on the channel and in my Substack, so make sure to subscribe. Thank you so much to Zen Business for sponsoring my research. You guys are awesome, and I will see you next time.